Alright guys, welcome back for another video. Well, in the previous video I uploaded, it was a very high level view of the market and talked about a lot of big picture topics, but I want to expand on that further and sort of do a 10,000 level view, 10,000 mile view on the sovereign debt crisis, why I think that's the most important issue affecting markets at this time, and how it's going to affect different currencies globally and what kind of impact that will have moving forward. So I do think this will be a very high level view, but I do think it's also applicable to things that will unfold in quarter 3 and quarter 4 going into year end. So it will be some very actionable information. Again, not financial advice. And so I do want to start with the issue of the sovereign debt crisis. So right now we're looking at the U.S. debt clock. Sort of puts things in perspective. You got the national debt. Really the most important thing here is the U.S. national debt and the unfunded liabilities, which is down here. If you add these all together, the true national debt of the U.S., including unfunded liabilities, is $200 trillion. So we'll revisit that in a second, but also to put the idea of long-term portfolio management into context, the reason why it's important is because of long-term gains and short-term capital gains. So, I'm American. I'm assuming people watching this video are American, but if you're not, it may not apply to you. But I'm certainly American, and it definitely applies to me. You've got these high variation in short-term capital gains and long-term capital gains rates. So if you're it comes a significant factor when you're trading in serious size. If you're pulling in $1 million in profit or even $100,000 in profit, at that size, then you're incurring a significant tax liability. And if that it makes a big difference if that tax liability is taxed at short-term capital gains rate or long-term capital gains rate. And generally speaking, for the most part, long-term capital gains are going to be taxed roughly half of what short-term capital gains rates are taxed at. But again, there's a lot of variation there. But again, it is significantly important. The idea is that if you're managing a portfolio, and you want to have the major assets and liquid assets globally in your portfolio, and you want them to be, or some of them to be at, long-term capital gains basis, meaning you've held them for a year or more. Because really the ideal scenario is to, whatever asset you're holding, to have them at a long-term capital gains basis, have held them for 12 months or more, and be able to unload that leg of a portfolio into a parabolic rally in whatever the prospective asset class is. If you're constructing a portfolio, you do kind of want to avoid, you want to have assets that are not necessarily correlated, because it's just ideal to, it's like a game of whack-a-mole, right? If you have a portfolio that's constructed of high, deeply liquid market assets that are uncorrelated, then your odds of one of those legs of the portfolio entering a parabolic rally at any given time are significantly higher. Anyway, so starting at, if I were to construct a portfolio, I would, if I was an institutional portfolio management manager, and you handed me, $1 billion on today and said, okay, manage this portfolio. Well, I would start to construct the different legs of the portfolio, and I would put in there the most highly, the currencies with the, deepest, most liquid markets, and what I believe to be but beyond the deepest and most liquid markets, the currencies that I believe to be the hardest, with the scarcest supply, and the most relevant on the big picture. So for me, that would be, I've got all these different assets up here. We've got Bitcoin right here, gold right here, oil right here, the dollar, and then TLT, which represents a 20-year Treasury bond ETF. So, if you're going to construct a portfolio, you would have you're going to have some Bitcoin in it. You're going to have some gold. I think you should also have some oil. As oil is not exactly a currency, but it is an economic currency, meaning that pretty much every economic activity in the entire world depends on oil. So in a lot of ways, oil is a global reserve currency. And part of what gives the dollar value is the fact that oil is, to some degree, and used to be settled in dollars. Now that's changing a little bit. You see countries like Saudi Arabia, starting to settle oil in currencies other than the dollar. But the dollar still is the currency that settles most of the world's energy trade, oil and other trade, just broadly speaking, globally. And that's really what gives it its fundamental value. And then, of course, you'd have some treasury bonds in that portfolio. Now, really, if you're buying, what you can see here is, the treasury bond ETF has gone down very dramatically since, July 20th. But really, that's just a reflection of yields, right? If yields rise on bonds, then the value of bonds are going to go down. That's why you saw Silicon Valley Bank blow up, and the government had to bail them out because they had a bond portfolio, and the interest rates rose very quickly, and the value of the bonds went dramatically, and went down dramatically, and that's what you're seeing here in this ETF. So essentially, a bond portfolio is a bet on interest rates. So, if you think that the Federal Reserve or yields in the bond market broadly have topped out, then you would want to purchase these bonds. Now, personally, I think the bond market has topped out, and bonds have found a local bottom, and that yields have topped out. But we'll revisit that in a little bit. But anyway, I'm just sort of trying to run through, some of the assets I would put in a portfolio. But I do want to zoom out again to the big picture and talk about the sovereign debt crisis. So you have, basically, if you combine the U.S. national debt of $32.4 trillion with all the unfunded liabilities down here, you get roughly $200 trillion. Now, if you guys were following the debt ceiling debacle a couple of weeks ago, early June, that on real terms, the U.S. government would have a hard time paying down even $50 billion in debt, 50 billion with a B. Now, their debt is 32.5 with unfunded liabilities is 200 trillion. So you can see how the government would have a very difficult time paying off $50 billion in real terms. And just the reality of them paying down their debt in real terms of 200 trillion is just extremely unrealistic. Now, what they have to do to pay down their debt is to issue more debt, right? So they can't pay down their debt in real terms. They have to issue more debt to pay old debt. Well, that's a Ponzi scheme. And it's not unique to America. It's pretty much happening in every country around the world. Pretty much every central bank around the world is doing the same thing, that not really the central bank, but pretty much every government in the world is issuing more debt than they're able to pay off. And so you have this highly leveraged Ponzi scheme where central banks of the world are, acting as the lender of last resort. And when they're the lender of last resort, that's primarily to the government, to fund these operating deficits. So they're acting as the lender of last resort and trying to fight inflation at the same time by raising interest rates. Well, that doesn't work, right? It's like trying to ride two horses with one ass, right? It just doesn't work. What it does create is very significant volatility in the currency markets, and I think you'll see that pick up. You'll see you'll see, if you're looking at the dollar currency index, you'll see, the dollar decline against other central bank currencies like the euro or the yen at certain times, and then strengthen dramatically. And you'll see an impulse in volatility as different central banks are entering different, monetary regimes and monetary policy stances. Like you can see that now with the dollar, where the Federal Reserve rose interest rates earlier than other central banks, and the dollar went parabolic through 2021 and 2022, while other central banks, hadn't raised rates yet. And then now, the parabolic blew off, and now the Fed is, pausing interest rates. They're not raising, they're not lowering it, but other banks now are starting to hike interest rates, like the euro, and you're seeing, the dollar decline relative to the euro, because they're at different phases in their respective monetary cycles. But I think those cycles will shorten, and you'll see greater volatility between each cycle. So if you are a Forex trader, that's good news for you, because volatility is a trader's best friend. But I would argue not to get swept up in that volatility, and not to chase price, because things can move in a very volatile nature and then just, head back to the equilibrium. So you always want to, keep that in mind whenever the market sort of breaks the limitations of what people expect to be possible. Because especially in fiat currencies, they're mean reverting relative to one another. So if, the euro, starts to rise against the dollar, doesn't mean the dollar is going to fall forever against the euro. There will be changes. Maybe the Fed starts tightening in the future while the euro, the ECB is cutting interest rates. You'll see the dollar dramatically rise against the euro again. But that's not the moment we're in. So, again, zooming out towards the sovereign debt crisis and putting the this big picture problem into perspective, with the understanding that this problem affects not just America, but every other country pretty much in the world. You can see how I've sort of developed a bias against fiat currencies relative to other energy commodities and currencies that hold their value in energy terms relative to fiat currencies. So that's why my bias is towards Bitcoin, because I believe Bitcoin holds its value in terms of energy or kilowatt hours to the greatest degree of any currency. If you're a human being, you need to be able to produce more energy than you consume or you die. Or you need to consume more energy than you produce or you die. Well, it's the same with currencies, right? I mean, a currency, any valuable currency needs to represent some type of energy input. And that's very important because it reflects, that's the underlying value that currency holds ultimately, because energy is the underlying currency that powers the economy. Right? I mean, you need oil primarily and other resources, energy commodities, to power the international economy. And that's why oil is very important. But, the thing that oil doesn't do is it doesn't hold its value over time, right? You can't just buy a bunch of oil and store it in a warehouse forever, right? Oil spoils, right? You got to use it or lose it. But it does have other things, like a relatively scarce supply and relatively inelastic demand. People are going to need oil, no matter what happens, really. But, very few currencies can, energy commodities can actually hold their value over time. And that's why Bitcoin and gold are the most important energy commodities. I do think Bitcoin is a commodity at this point. But the reason why they're the most important is because they can, hold energy value over time in a way that other energy commodities can't. And, gold is certainly that way. Gold, takes energy and human work power, carbon fuels to literally extract gold out of the earth. And once you've extracted that gold, it has a monetary value that lasts forever. I mean, gold does not expire in any way. We've found gold, in the Egyptian tombs, and it could stay there for another million years and it would still be gold. And Bitcoin is the same way, assuming that Bitcoin, the network keeps running, miners still plug into the network, keep validating blocks, Bitcoin will exist, and the Bitcoin that you have on the network will never decay. And that's a very important feature, and one of the reasons why I think Bitcoin and gold are obviously the most important going forward. So you've got a little bit of a dichotomy here, where you have a lot of countries that understand the sovereign debt crisis, and they're sort of trying to find their own unique solution that is sort of unique depending on their culture and where they're at in their realization of the importance of Bitcoin. Different countries are at different stages, but you do see this sort of fracture between the East and the West, where Eastern countries are starting to lean towards gold, and Western, not necessarily countries, but the people within those Western countries are leaning towards Bitcoin, and that's sort of a cultural thing. You've got I don't really want to dive into the cultural nuances of India, Russia, and China, but you certainly got that there. And then you've got most of the world's Bitcoin is held in America by American citizens, but you've also got the Silicon Valley, based in San Francisco. And now actually you also have the most hash power in the world, mining rigs coming out of America. So you've sort of got this situation where America is leaning towards Bitcoin for the solution to their sovereign debt crisis, and countries like Russia and China are leaning towards gold. And you're sort of seeing a fracturing between, global trade. You're seeing things sort of, especially with the Russia-Ukraine war, you're seeing these battle lines being drawn between the East and the West, and countries that, especially in like the global South, like South America, Africa, Southern Asia, the Middle East, countries that aren't necessarily allies to America or Russia or China. You're seeing they're sort of now in this current geopolitical environment, they're sort of forced to make a decision between who they ally with. And I think that'll have, that's important, it has important implications because, I think you'll see countries that ally with China and Russia start to settle trade in Chinese yuan, but not necessarily hold the Chinese currency. They will, probably, in my opinion, convert that to gold. And one of the reasons why that is the largest gold exchange in the world is the Shanghai Gold Exchange, obviously in China. So people can use, so actually, now I'm looking at this gold US dollar, but if we went to Yuan XAU, see if we can find it. It might take too much time to pull up, but really the most important exchange is the Shanghai exchange, which is actually gold Chinese yuan trading pair, more important than the gold USD trading pair. And the reason why it's significant is you have most of the volume coming on the Shanghai exchange from a country who holds gold. And so Western central banks and governments can't manipulate the price of gold as well as they used to when there wasn't that amount of volume flowing through the Shanghai exchange, which they obviously can't control. So you've got a situation where globally a lot of the trade that was previously settled in US dollars is now being settled in Chinese yuan, and the countries that are receive the yuan for their trade surplus, they're generally doing two things with that. They generally tend to be Eastern countries who use that the Chinese currency to buy Chinese goods, and then whatever excess they have that they beyond their need for Chinese goods, they go onto the Shanghai exchange and use it to purchase gold, which they then hold as their reserve asset. And you can make a significant argument. You're seeing gold rallying in the price, dramatically from September 2022 up to, while you're seeing bonds fall in value dramatically. And, that this really is, the fall in bond prices is really primarily due to the rise in yields, which is primarily due to the Federal Reserve raising interest rates. But it's also due to the fact that, a lot of countries are no longer holding treasuries as a reserve asset. They may not be dumping them, but they tend to be letting them reach maturity and then roll off their balance sheet. And now they're storing excess, their trade surplus. If they have a trade surplus, they're storing it in gold as their reserve asset if they're an Eastern country. Or even Western country, but primarily you're seeing this unfold in the East, where you have countries that, are not really allies with America, and really they're really skeptical of holding treasuries, particularly after what we saw happen to Russia in the Ukraine war. So Russia invaded in March of 2022, last year. And that was when the U.S. Treasury seized the Central Bank of Russia's treasury reserves. And, that was a very important action for many reasons. I think we'll look back at that day and realize that that was really the day that catalyzed the end of U.S. Treasuries, and as a corollary, the U.S. dollar being the reserve asset of the world. Or, it was the day that it started to unwind. That might not be apparent now, but I think we'll look back at it in the future and realize, that what they did by censoring, essentially freezing Russian reserves and stealing them was a fatal mistake. And the reason why it was fatal was, treasuries are supposed to be the most, what people used to refer to as pristine collateral. So, meaning that it was, quote unquote, the safest asset that people could rely on in times of unique strain and financial chaos, right? If you're uncertain about what's going to happen in the world globally, in the markets, previously you would hold, you'd increase your allocation to treasury bonds because you knew you could rely on them if that chaos and uncertainty unfolded. Well, now that, the U.S. Treasury has started seizing treasuries, it's no longer, it loses that status as pristine collateral because, it can just be seized at any moment. So if there was a global conflict and things start to break down, how many countries, treasury savings would the U.S. government seize? The fact that there isn't an answer to that question, or a certain answer to that question, is exactly why they're no longer low risk assets. So a lot of these countries who saw Russia have their treasury seized, unless they're immediate allies of America like Japan or the UK, if there's somebody like Indonesia, right, or Colombia, or someone who's not clearly an ally but not necessarily an enemy, even they have to start to analyze into their risk models, okay, well, maybe we're not hostile to America now, but what if we what if we fall into bad terms with them? Do they then seize our treasuries? Like, again, the fact that there's not a certain answer to that is exactly why, these countries have stopped saving in treasuries. Now, a lot of these countries like China, the treasuries they hold their holdings are so large that they can't necessarily dump on the market without crashing the market. So what they've been doing and tended to do recently is sort of let those roll off their balance sheet, and as those hit maturities, rather than sweeping excess capital back into the treasury market, they're starting to sweep that into the gold market. And I think ultimately, countries will start doing that in Bitcoin once they realize that Bitcoin is a better asset than gold. But I don't think we're like there at that inflection point in the world yet. I do think it's coming. I just don't think we're there right now. So, yeah, a long way of saying that, I think gold will do very well when the sovereign debt market starts unwinding. The way you can kind of quantify how a sovereign debt market is starting to unwind is, you can look at the bond market, or we'll go here to TLT, and you want to look at, okay, if you look at the total auctions of U.S. Treasuries, what percentage of that is being bought by the central bank, and what percentage of those auctions is being bought by actual real market participants who are buying it with their own capital and risking their own capital that they didn't create, out of thin air. When you get like Japan currently right now, they have the Central Bank of Japan owns over 50% of the entire Japanese bond market. At that point, there's really there's no market there, because they're really just buying bonds with money they created. And in Japan, you can get to a point where, the central bank has to buy so many bonds to keep yields low at their target that they end up, the government they'll buy up every single bond on the entire market, and they'll have no bonds left to buy. So the Japanese government has to issue more debt just so that the Bank of Japan has something to buy. And again, that's like a really escalated form of a sovereign debt crisis, but I do think it's a good indicator of what's coming for other Western countries. Like Japan is it's further along its sovereign debt crisis, right? And it's a good example of how, things can kind of they can let the air out of the bubble over decades, and it doesn't necessarily have to be a monumental collapse, although it could be. You could have a collapse in the US market, the Canadian market, the European market. You don't know, but you could also have just sort of a slow deflation of the bubble like you see in Japan, and you just see more and more of the bond market being bought out by the central bank, and less demand for those bonds from actual capital. But again, I don't think we're there yet, and I really don't think that that'll happen to the U.S. first. I think it'll happen to other non-U.S. Western countries first, like the Canadian bond market, the European bond market, the Australian bond market. And those, I do think that those currencies over time will start to collapse into the dollar, and but again, it's sort of, I do want to tie things pull that big picture into my base case for what I think is going to happen in quarter three. In order to do that, I need to talk about interest rates, I need to talk about the equity markets, and I need to also talk about the bond market as it relates to what's happening in the equity market. Now, the reason why I'm looking at the equity market and kind of focusing this part of my argument around it is because I think the Federal Reserve is also looking at it and focusing on it. And I do think that the equity markets will be the cause for the Fed making a critical error in their judgment. And I'll get back to that in a second. But, my previous video uploaded, I think, a week ago, I made the case for how I think, assuming that there's a collapse in CPI and interest rate expectations fall away, that my base case is that Q3 creates new highs. Well, we're only a week into quarter three, and you're seeing it sell off a little bit from the open. We actually get our next CPI report on Wednesday of next week. So I'll put that on the Wednesday of next week. So I think, you could say with reasonable certainty that if the CPI numbers come in pretty low Wednesday of next week relative to expectation, and my theory does play out, then you'll probably, take out these local highs. And again, assuming the CPI comes in low next week, then you'll see, actually I got it a little bit messed up here. It's actually Wednesday the 12th. So yeah, Wednesday of next week. If we see CPI come in low, probably take out these local highs and start running up. And again, you'll have multiple CPI reports, probably 3 or 4 within this next quarter before the quarterly close. Let's see, when is the next quarterly close? In October. Yeah, so again, not perfect, but you'll see quarter three starts in October of 2023. So point being, we have our first CPI report in the quarter here, and then 3 or 4 more. If those CPI numbers come in below expectation and you see a continual decline in CPI readings week after week and month after month, then I'm looking for new highs in the equity markets. And I do think that, if these highs are taken out, that they'll be taken out very aggressively. And I think you'll see a parabolic leg of the equity markets play out. And, in that type of market, you can see, prices go from 480 up to 500 and then up to 600 very quickly, right? You see sort of a vertical market where all these, hedge fund managers are shifting their positions and they can't sit on the sidelines anymore. I mean, when the market's moving that aggressively to the upside and you're a fund manager, you can't hide in a 5% money management, money market account, just collecting a 5% annualized yield. People are going to start chasing the equity market, and that's the point where, things get very parabolic, but it also creates a short-lived environment where, if that were to happen, I would be hopefully exercising extreme caution, because again, I do think there's a potential for that high, again, assuming all these conditions play out, to be like the blow off top before a significant decline and an aggressive decline. And I think one of the reasons, one of the things that could cause that is, I think, at this point in the Fed's interest rate hiking cycle, I think they've raised interest rates too much, that they've squeezed credit markets too far. And I think you're seeing the lingering effects of that, or what they refer to as lag effects. It doesn't happen instantly when you raise interest rates, right? It takes there's a lag effect of 6 to 9 to 12 months for those credit to tighten on the wings of that interest rate rise. And I think the critical mistake that the Fed will make, in my eyes, is if the equity markets go parabolic and this scenario does play out, I think they'll continue to hike interest rates to try to dampen the equity market and try to fight the equity market down. And I think that'll be their fatal mistake, because in my opinion, they've already tightened interest rates too much, and anything further than this is just going to drastically impact credit markets, to the point where, you see major institutions, going under because of the financial stress. And the way that would manifest itself is in very severe, a very, very severe recession. And, I don't want to use the word depression, but you could see unemployment get up to like 20%. A lot of foreclosures, people not able to pay their mortgages, see a housing market crash, things like that, things that, could potentially surprise people. Again, that's if the Federal Reserve continues to, raise interest rates. I don't think there's any reason for them to do, because CPI is declining dramatically. But again, it's always on the table for them. They have the power to do that. But again, I think it'd be a big mistake. If they did do that, if you did have a massive deflationary collapse, following like a melt-up move, or even without a melt-up move, I mean, regardless of if you get that final melt-up or not, if you had a deflationary collapse, that's when the Federal Reserve would really step in and start cutting rates and, bringing out the money printer, because, markets, when they collapse very quickly. Things happen very fast, and, there's not enough time to wait for people in Washington to, convene and change policy. Like, you have to act quickly, and really the only tool the Fed has to intervene in markets is their ability to print money and to eject that money directly into the economy, or to lend that money into the economy. So, I do, but it's only a possibility if you're in the middle of a deflationary spiral, right? You can't, the Federal Reserve is not going to unleash the money printer if inflation's above 10%. But they certainly will in a deflationary collapse, right? If they're looking at the collapse of like the global banking system, they certainly will start unleashing the money printer, and they won't be worrying about about inflation, because it will be in the midst of a deflationary collapse. So as long as they have deflation, they will lean on the money printer. It's when you have, like, if you had persistent double-digit inflation, where, the Fed, and you have like a systemic collapse in that environment, that, that's like the end game for the Fed, right? They're sort of backed in the corner. There's nothing they can do. Now, if you had that scenario where, you have a collapse in the economy, and, you get a major recession, that would definitely be a top in yields. And I think you would see interest rates on bonds, otherwise known as yields, start to collapse dramatically, and the underlying value of those bonds would go up pretty dramatically. So again, I personally, if I saw, the equity markets start to enter that melt-up phase, I really wouldn't be trying to chase the equity markets. I would start to look to accumulate treasury bonds actually in that environment, because it would be a bet that interest rates or yields have topped out, right? That, or at least they are close to topping out. Especially if the Fed does like one last interest rate hike as the equity markets are rising, I would want to buy after that interest rate hike, not before. So that's a very important distinction. But, also you've got the oil market as well. I think, if you had a deflationary collapse, you would, in that deflationary collapse, you'd see oil prices decline pretty dramatically. But you'd know that in that deflationary collapse that the Federal Reserve would almost guaranteed to bring out the money printer, which would create you know, probably at this point, $10 trillion, maybe even $15 trillion of new currency. And, you know, that would increase the price of oil because oil trades relative to currencies. So even without a change in demand, you'd still see the price of oil rise in that environment after the bailout, because the underlying price, or, you know, there's more currency and the same amount of barrels of oil. So supply and demand, with demand remaining constant, if the supply of dollars goes up and the supply of oil remains the same, then the value of oil relative to dollars will go up as well. So I think, but I also want to back off a little bit from that prediction and kind of, I guess my point here, and just to reiterate my base case, is bullish on the equities markets as well as Bitcoin going into the halving, on the, you know, the condition that CPI continues to fall week after week and month after month. And then when equity markets take out the old highs and say you got that parabolic vertical rally, that would be when I would start to de-risk a portfolio, and I would start to you know, move from quote unquote risky assets like equities and even Bitcoin into your quote unquote safer assets of gold, even cash, US dollars, and is also treasury bonds. And then I would look to, you know, let's say, you know, you run up to here and you start to, you know, have a big position in treasury bonds and gold and those safer assets, and then the market, you know, declines off that parabolic rise. Well, then that would be an opportunity to, you know, load up on things like Bitcoin and oil, things that generally speaking hold their energy value over time. So again, I feel like I'm sort of getting lost in the weeds here. So I'll go back to Bitcoin and talk about what I see happening on Bitcoin and what my base case is here. So I still have this position open. This is not my real account. It's a paper trading account that I've been, you know, started at 2.3 million, and now the account balance is at 4.4 million. But total equity is at 15 million. You can see most of that equity is represented by this still open position I have here of 857 Bitcoin. But recently I've been taking a lot of risk off this position, and I've been doing it, let's see, close this window here, at very specific levels. So I had my first take profit right here above these old highs right here, and then a second take profit above the local highs. So you have take profit above the old highs, historic highs, and then the local highs as well. So this is really good. You know, price ran up above the old highs, and I had my order actually 31,111, got filled, and then price immediately went off it. I had my second TP up here above these local highs created when the old highs were ran above here, and price sort of over the 4th of July weekend came very, very, very close to that high. I think I had my order at 31444, and you know, didn't quite get there, and that sort of price behavior sort of puts me on tilt. You know, there's nothing that puts me on tilt quite like missing an order by, you know, a couple dollars. But the market was gracious enough to fill that order right here for me, hit that sell order right here at 31,444, and then sort of you know, starting running back towards the base of the consolidation. Anytime you see this type of price action, like you have, particularly, let's pull everything off the screen. Anytime you have price action that, runs, you have this consolidating price action coming off an impulsive move, right? Got this impulsive leg up, then it runs up above the old highs and then kind of runs the stops above those old highs and then starts consolidating. When you see that, and then you see a run off the consolidations right above the old highs and then slamming back down and then testing off the base, that's generally not a good sign. It certainly doesn't mean that support has to break, but especially if you would see like price start to come back down and revisit the support, this support's been tested a lot of times, and it's another good way of saying that this area here would actually really make a great area for a stop loss. I think, based off this price action we've seen, it's tested this level multiple times, had a fake out above the highs of the consolidation, slammed back down, had sort of a dead cat bounce off that consolidation. This would be a fantastic area to have a stop loss. And actually, I'm going to put a stop loss in the market right now. So we'll see. So we got 29,725. And we'll just do 69 units. Again, you might ask, well, your position is 859 Bitcoin. Why are you only taking off 69? Isn't that a fraction of the price? Well, this is a very long-term position. I mean, I got a great position, really what I think is the bottom of the 4-year cycle. So I don't want to, totally offload that great position, but I do want to manage it dynamically, and where appropriate, start pulling in profit off this equity, this 10 million equity. And so, yeah, I've got that stop loss. Again, this is not the first point within this consolidation I sold. I had to sell above the old high here and above the local high here. But I do think this area is a good region to take a little bit of risk off, because there is a possibility the price just continues onward and upward. It's Bitcoin, can certainly do that at any moment, but based on the price action principles we just described, I think this is a good area for a stop loss, and at least one that I'm using personally. Now, let's say that region is broken. What areas am I looking at next? Well, Bitcoin has been in a very clear uptrend for basically the better part of the year, really, since the beginning of the year. And I think, especially if equities continue their run like I think they will in Q3 and Q4, and CPI continues to decline, then I think, you'll also see Bitcoin also continue its rally into the end of the year. But really the price distinctions that I'm really focused on right now is you see this very clear behavior here where you've got you had your first break right here, right? So price came up, stalled there a little bit, broke above, came back, retested, rallied up above these highs, and then ran back into this level. But you get this clear, distinctive pattern that is playing out over and over and over. And here you mark it here. Mark it by this. Okay, it's a little rough. The charts weren't marked up when I started the video, but you get the idea. Price is running down into these levels and reacting off it, and that's really what I want to see. You have the same distinction right here. So mark this off right here. It is important to mention that while I do have opinions on the equity market, I don't actually trade the equity markets, so I think they're less relevant than my opinions on the Bitcoin market, which I do actively trade and am, constantly watching and, seeing new developments. But this is what I'm looking for. You've got this run up into, above these old highs and then run back down, and you can see the same clear distinct pattern of running just below those highs, right here. And then that serves as a base for the next rally. Got to stop run up here, slam back down, consolidate below the highs, vertical accumulation, and then run up above, consolidate, run up, and then run back into the highs that were previously broken. Support turned resistance, right? Or resistance turned support. But another key distinction you can see here is as this uptrend is playing out, you see that the uptrend actually gets stronger and stronger. And the way you can see that is because it violates the highs, less so on each test, right? And that's a characteristic you want to see if you want to see a strong uptrend, right? Anytime you see a filling of this inefficiency back into old highs, you want to see price react quickly and aggressively off that level if the uptrend is to be looked at as a strong uptrend. You see that here, right? It kind of violates it pretty significantly by, a couple thousand here, but then reacts dramatically off that. It doesn't hang out down at these levels. That's what you don't want to see in an uptrend, is you don't want to see, this type of price behavior and then like a consolidation at this level. You want to see a reaction quickly, right? So that's a way to introduce the element of time into your trading. And you see that here, reacts quickly. Same thing here. This time violating it less so than here, and having an even quicker reaction, right, in the space of 24 hours. And then again, we have the old highs here, in that area marked off. So it's got out of the 4 hour. For the reasons I described before, I think this area would be a good place for a stop loss. And if that area is violated, then I would look for 29,725 roughly, to for price to retrace. Let's see, get something out of that. Here we go. So you'd see something sort of like this. It's not clear how, how far price would come into these highs. You might get something like this where price, rallies off it, bounces off it, comes back, and then, creates a set of local lows here, swipes those local lows, and then runs back above, does some type of pattern like that. Doesn't really matter how that plays out. Just the point is that if I don't want to see price spending several weeks below this level, right? If that happens, I start to be more aggressive in managing risk and not looking at it as an uptrend. But again, that's several steps ahead from where we're at right now. Where we're at right now, this is still a very aggressive uptrend. And assuming it maintains itself, I would be looking, price may, there may be a little bit of a dip. But assuming that, price stays above this 28,500 level, I would be looking upwards for areas of interest, and primarily this level up here, 36,000. The reason being, you don't have any, at least on the weekly chart, you don't have any candle body closures within this region. So this region represents an area of relative inefficiency relative to these areas right here. So you see these inefficiencies get filled, right? We saw that in the last few weeks of price action. You have price rally dramatically up into this level, leaving this area of inefficiency really represented by the area between this low right here created within this consolidation and this high right here created within this consolidation. So you have price running dramatically above and then fills the inefficiency here by running into these old highs. It did take a while. It took, several weeks, but it ultimately did that and then ran up. And we did, again, create this minor inefficiency here. Now it's not obviously, there are no guarantees in the market. Not every inefficiency has to be filled. But this is just sort of the way I look at the market and try to create a set of probabilistic expectations of what is most likely to happen. And again, yeah, I see, so to put things in context, right, this area of inefficiency between these local lows here and these local highs here is relatively insignificant relative to the area of inefficiency here. So, I think that context does matter, and it does equate to this area being more significant than this area as well. So you could, see price just run up for this level right here. But, I think, I don't know that if Bitcoin ran up to these levels, I don't know that that would necessarily be the time to sell Bitcoin. Like, I think price could, even make a run for these highs up here. If you put a Fibonacci retracement over this entire macro swing from the all-time highs up here at 69,000 down to the post-FTX collapse lows down here at 15,000 roughly. Your 618 is right above these highs right here, which is where, obviously, this is an obvious swing high from historical price action. There'd be a lot of stop losses here. So there's a lot of liquidity above here lining up with the 618. I think price certainly could. But the way I'm looking at the market is, just from a purely technical level, this area is a technical resistance. And what I'm actually looking for is if Bitcoin runs up into this resistance up here, I'm not necessarily looking for it to top out and fall over, especially initially, right? I mean, if you have a very parabolic rally running into these levels, I think what's more likely to happen is that Bitcoin starts to stall at those levels relative to, the altcoin market. So I think if you see like Bitcoin run up to 36,000 and stall for a little bit, and then make another push to like 40,000, stall for a little bit, I think that would actually mark the top in Bitcoin dominance. Maybe it tops out up here or whatever. But that's how I'd be looking at it. I think, Ethereum would start to move. I think, other way to put it is when Bitcoin encounters this resistance up here, I think you probably see a bottom in Ethereum, Bitcoin, and you also probably see an altcoin season, so to speak. That would be an area where I would start to be looking to either sell Bitcoin into altcoins and make altcoin plays, and sort of move out into the risk curve. Because again, if this were to happen, lining up with my theory on the equity market, this probably happens. Bitcoin probably would reach up into these levels right around the time when the equity market is creating new highs and starting to go parabolic. So that's really kind of the environment where you want to be, buying altcoins if you ever buy them at all, is you want to do those plays in the time in the market where things are just moving stupidly and, everything's going up. And, but again, you don't want to be sucked into the mentality that everything, it's a new paradigm and everything's going to go up forever, right? You want to be very, like I would never have altcoins in a portfolio that I just hold for long term, because, I would always manage it with a stop loss. And I don't look at altcoins outside of Ethereum with that long-term mindset, because I don't know if, I just don't know if they're going to be around or what their value will be in 12 months. But, on a short-term level, that would be how I'd be approaching the market. Again, this is not financial advice. It's really just the way I'm looking at the market. Again, if equities make new highs, I think the Federal Reserve will probably make the fatal mistake of tightening interest rates further to try to fight down the market. And I think that'll be the fatal flaw that causes a recession. And, that would be, if you see that happen, at least me personally, that would be the time when I would want to buy bonds on the back of those interest rate hikes. You've already seen a significant amount of pain in the bond market. And while I do think over the long term, 10 years, 20 years, bond investors are going to lose their shirt if they just hodl bonds with a long time horizon. There certainly are short-term plays within those cycles, and that would be a short-term bond play that I would be interested in because, I would, again, for all the reasons I mentioned, I think it's a unique short-term opportunity. Anyway, so hope you guys like this video. I know I covered a range of topics, but